The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A full-on embrace of an S&P at 5,600 and a loss of enthusiasm for a president at 81. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. One question for you. Netherlands or England?
Netherlands or England? Is this a trick question?
No, they're playing right now.
USA, USA, USA.
All right, I'm going to go with England, but whatever. Okay, so as Romaine was saying, S&P 500 topping 5,600. It really is truly led by tech. You see the Nasdaq 100 up by 1 percentage point. You have Apple a record, also Alphabet at a record as well. The VIX goes nowhere fast, and I bring that up because we are getting into some volatility here potentially when it comes to CPI, when it comes to bank earnings. Will we wind up seeing some final movement and volatility in the VIX at 12? Romaine, I don't know.
Yeah, it should be noted when we take a look at the complexion of this rally, and it is an impressive rally indeed here, but we should point out this is actually going to be the broadest rally that we've seen going back to May 31st. Right now, roughly about 70 to 75% of the members in the S&P are higher on the day, and that could increase as we get closer to the bells. Though we should point out, while stocks are up for a 7th straight day, trading volume across the U.S. tapes, that's been well below the 20-day, 100-day, and 6-month daily averages over that same stretch, and that could be a problem. Though volume could pick up tomorrow. That's, of course, with the big pre-market release of the U.S. consumer price data. The options market betting that the S&P is going to move roughly about 0.8% in either direction after the report, at least according to Stuart Kaiser over at Citi. Bloomberg Economics expecting a, quote, really good report, borrowing a phrase from Fed Chair Jay Powell in his characterization of recent inflation prints.
I have some confidence. As I said earlier, that we are on a downward path. I think if you look at the data, it's pretty clear that, but we have not said, though, that we have sufficient confidence, and that will be a decision that our committee makes.
And one other story to keep an eye on today, of course, is that persistent din around whether President Joe Biden should end his re-election bid amid concern about his physical and mental fitness. Two prominent voices weighing in today, saying that Joe needs to go. We're going to have that story in a moment, but let's circle back to what's actually moving the markets here. And a lot of talk right now about the start of earnings season coming up here, I guess, officially tomorrow.
I mean, what we hope, I guess, is movement in the earnings season where we will get some idiosyncratic moves. So let's take a look at this. I've been talking about this for a couple days, but it's the broadening earnings growth potential. So this is from the EA function on the terminal. You go to growth and you go to earnings growth percentage. And then you take a look at the individual sectors and you can kind of see what we're expecting this quarter. And it's not just tech. In fact, tech is only going to see 44% growth there. It's really going to be led by financials, discretionary, as well as healthcare. Obviously, staples and materials are going to be struggling a little bit. The overall growth picture for the earnings side is going to come in just around 4.5% versus the growth forecast at about 8%. So the question becomes, can they beat it? Are estimates too high? And can we finally see the broadening out in earnings, delivering some of the idiosyncratic risk that can kind of get a market moving, Romaine?
Yeah, it's the big question that's on the top of every investor's mind. So let's try to get some answers to that from a brilliant mind in this space. Heather Brilliant joining us right now to kick us off to the close. She's the CEO over at Diamond Hill, which has about $29 billion in assets under management. And first, I'd like to say thank you for wearing purple today here. I feel underdressed here as well, a fellow Wildcat. But let's talk about the start of earnings season here. There's been a lot of talk about how this market isn't the aggregate market that we tend to sort of focus on. It is much more idiosyncratic, at least way more than what it was over the last few years here. How does that affect, if at all, the setup into earnings season?
Well, I first of all think that there's so many high expectations built into some of those tech stocks. And so whether the market can sustain this rally, I think, has everything to do with those stocks. And, Alex was even talking earlier about the VIX being so low. And I think that's so interesting, the overall volatility still looking so low when underneath the surface, there's so much more volatility in the individual names. The dispersion we're seeing is pretty unprecedented. It's
pretty unprecedented, but it also creates value or opportunity, I should say, for those stock pickers out there, right? I mean, I guess you could just, hitch your wagon to NVIDIA and hope for the best. But I think the more experienced people like yourself realize there's more to life than just NVIDIA. Where are you finding it?
we completely agree that this is a great opportunity and really does open the door. I think one of the things we think looks pretty interesting is Starbucks. So yes, Starbucks, obviously a household name, and they've certainly undergone some challenges recently. You know, they've had some changes in the senior ranks, and they've also had some operational challenges, kind of meeting demand in the morning and getting enough demand in the afternoons. And I think that's something that is temporary to some extent, and that they can work through over time. I think there's also an overhang from China, and you know, really China's quite a small part of the business. It's only around 5%, and so even if you exclude China, we think the valuation looks really attractive here.
So on the other side, it's like, ooh, consumer discretionary, that's not going to do well. We're going to be in value wars. Just take a look at what happened with Kellogg today. That's not going to work out for Starbucks, but then that's kind of the idea, right? That you have a sector theme, but individually you can find those stocks that are going to have some upside.
Exactly. And I think Starbucks, because it's such a habitual item, you know, some might even say addictive, that, you know, people need their coffee and they're still going in for it. And there's not the same level of competition, I think, when it comes to Starbucks versus some of its competitors, as you see in like the broad restaurant space.
Funnily enough, I keep meeting more and more people who don't drink coffee, which is a real head scratcher to me. I have 3 cups right here. So what other sectors / stocks provide that unique opportunity?
Well, another one we think looks really interesting in the smaller cap space is Red Rock Resorts. This is essentially a company that owns some real estate in Las Vegas and has developed a number of casinos in the locals market. And Vegas and, you know, Nevada more broadly as a no income tax state, it has been seeing meaningful population growth, and I think Red Rock is really well positioned to capitalize on the existing population of, you know, non-strip casinos, but also really has a lockup on the land to be able to build future ones as demand continues to grow.
Another interesting pick that I saw coming out of your folks, and this is one that I'm not too familiar with, but it's more of an international play. Talk about that.
So Capstone Copper is really interesting because I think as we see continued electrification and growth in areas like AI and demand for you know, for more and more ability to meet the electricity needs of our future technology-driven economy, we're going to need more copper. And so Capstone is a really interesting company because it's headquartered in Canada. Its biggest mine is in Chile, and it just completed a huge project there that was finished on time and on budget, which pretty much no one can say in that industry.
Never happens.
And it also gives it capacity in an industry where, you know, you do have to keep on investing in order to continue to generate that capacity.
We'd be remiss in not asking you a little bit about the macro. I know you're much more of a bottom-up type person here, but I'm sure you have your eye on what's going on with the economy. We have a big inflation print coming tomorrow that may or may not ratify that disinflation narrative that this market has really hung its hat on. What are you expecting?
I don't really have any specific expectations for tomorrow other than that when the economic reality comes in differently than how the market's expecting, it generally creates opportunities for us. Because we're taking a longer term perspective, you know, we're okay with you know, dislocations that lead to opportunities for companies that we can predict the long-term earnings stream, even if in the short term they might get a little disrupted.
I just want to say too, I think this might be the first time that we've had an all Northwestern Wildcat folks around the table here today.
It's actually the second time.
Is it?
Was
this? Oh, we did this before?
I keep forgetting that I
Okay, I forget. Yeah, so anyway. All right. Well, it feels good. We wish we can keep you around for the entire show. Heather Brilliant, the CEO of Diamond Hill, helping us kick us off to the close here on this Wednesday afternoon. Coming up after the break here, a closer look at shares of Apple, rallying for once again to another record high, and partly on the back of a report that the company is targeting 10% growth in shipments of that new iPhone yet to be released. We're going to have the latest on their strategy. All
right, plus we're going to get insight to the state of the credit markets with Lauren Basmadjian, Global Head of Liquid Credit over at Carlyle.
And another stock actually moving to the upside, probably one of the biggest gainers on the year, is Carvana. And now Needham upgrading the company to buy from hold. We're going to talk about why that analyst is so confident on this stock, a stock that a lot of folks left for dead just 2 years ago. This is The Close on Bloomberg.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
The commercial real estate situation, which is, you know, it's significantly downtown office and related retail and things like that, This is something the banks have been working their way through for the last couple of years. I think it'll take more time, more years to work all the way through it. It doesn't seem to be a systemic problem or one that threatens broader financial stability. It does threaten bank profitability and those sorts of things, but it'll be with us a while. We'll just keep working our way through it.
That was Fed Chair Jay Powell speaking about the risk that commercial real estate poses to banks, which start reporting their latest results on Friday. Bloomberg's Neil Callahan has been covering commercial real estate, and he joins us now. Neil, I've been waiting for commercial real estate to just, implode. And instead, it seems like it's going to be a slow rolling ball that's going to take many years to kind of work its way out. What have you been noticing?
Yeah, 100%. Commercial real estate tends to be a much slower market decline than what you see in things like equities and bonds and credit. And partly that's because banks tend to not want to recognize the losses or manage the recognition of the losses over time. So commercial real estate crashes tend to take 4 to 5 years. In some cases, they can take much longer than that. And so we're really just at the end of the beginning of what's going to happen here. And you're starting to see that banks in the US and elsewhere are confessing to the problems in terms of some of the loan books. You're starting to see property funds say that their NAVs don't necessarily match what's happening, and you're really beginning to see the emergence of distress. And at the moment, private equity is really getting ready to take advantage of this, and it has the highest amount of money allocated to percentage-wise allocated to North America in 20 years. And that's because the distress tends to turn up there first, partly because it gets recognized, it gets dealt with, the assets get worked out. In the rest of the world, there tends to be a kind of a feeling of we have time and we're going to take our time and we're going to take a few years and we're going to, gradually recognize these losses. The US is much more quicker in terms of dealing with the problems.
So it's kind of interesting too, Neil, when we talk about where this money could go, the idea that it ends up concentrated maybe more in North America, in the US. But not only that, but according to your reporting, as well as other Bloomberg reporting, it's probably going to end up concentrated in more of the higher quality properties, or are there folks out there that are interested in something beyond Class A?
Yeah, I think the opportunity outside of Class A will be in repositioning. So you're going to find a lot of these old warehouse parks or suburban office parks that might get new life as data centers. Data centers is the hot new thing with the cloud and AI. So you're going to see people try to reposition assets like that. But in the main, it's going to be, what do we do with these big, huge downtown office blocks? How can we buy them at cheap enough prices, or that we can charge a low enough rent so that we can fill them up and make money that way when the market bounces back? So you're going to have a kind of bifurcation in terms of good assets in good locations that have too much debt and are suffering from work from home, and bad assets in good locations that would benefit from being turned into something completely else, something completely different. Mm-hmm. You're going to see some of these offices become hotels as well, for example, budget hotels.
Mm-hmm. That's not easy to do, though. I mean, you just can't flip a switch and change what commercial real estate's supposed to be. What kind of cost does that entail, though, and how does that sort of help the situation?
Yeah, the great myth is that you can take every empty office block in the world and just turn it into housing. The actual costs of doing that are enormous, because the floor to ceiling heights aren't the same. There's cabling, there's mechanical and engineering issues, there's fire escape issues. So the idea that you can turn it all into residential doesn't work. In a lot of cases, that's why it will be about wait until the asset falls so much that you can lower the rent and get people in there. And that's the solution long term, is that you don't have to charge $100 a square foot. You might be able to charge 40 and still make money.
All right, great stuff, Neil. Going to have to leave it there. Bloomberg, Neil Callahan there. A great story on the Bloomberg terminal. A closer look at the commercial property sector and how some people are looking for a crash and opportunity. One thing he said, though, about the conversion to hotels or to basically anything other than just office space. I actually stayed in a hotel that was actually a converted office space. I was in Chicago, and there was an old office building. But what was interesting about it was the hotel only occupied 3 or 4 floors. This was 20, 30-story building. They only occupied 3 or 4 stories. So it was kind of weird, but it was kind of an interesting way to do it. So rather than trying to convert the whole building, maybe you just take a certain portion of it, convert that into a hotel, and then find some other uses, retail, restaurants in the other space. Was the other part of the area rented out, or was it just those couple floors? It was hard to say, because clearly there were parts we couldn't go to, but it looked like there were offices still in there. There were residences in there, and there was retail on the ground floor and a restaurant couple of restaurants near the top. So it was a mix, but it certainly wasn't 100% occupied.
Mixed use. I mean, that in some ways makes a lot of sense.
But it was more the creative thought, I think, what struck me. It was like, oh, who would have thought that? Because you walk in, the hotel's not on the first floor. You have to go up an elevator. It was kind of confusing. And then once we got there, we're like, oh, okay.
You're like, where's my bellhop? Moving my luggage on the ground floor. Like, what's that about?
Like high maintenance. I just I don't like the bellhop because I got a tip.
No, I'm kidding. I don't carry cash. You can't do that. They have to have Venmo or else there's no point.
Yeah, have they not sorted this out?
I don't know. I think it's actually kind of
because it's like a big deal. Like whenever you're like, I want a tip, but
no, don't take my bag. I have no money.
Yeah. Anyway, it's convenient excuse there, Alex. All right, coming up here, we're going to take a look at some of the big movers on the day, including shares of Carvana moving higher today on the back of an upgrade over at Needham. The analyst setting the street high price target for a stock that a lot of people had left for dead just a couple of years ago. That's coming up next, right here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, the look at the big movers on the back of analyst recommendations. And we start off today with Spotify. Redburn downgrading the stock to sell with the price target at $230 a share right now. The analyst citing competitive and structural challenges for the music streaming industry that are going to make it difficult for any sustained pricing increases. Those shares down about 1% on the day. Next up, Kellogg, ticker KLG, the cereal maker, feeling the crunch of a downgrade to underperform over at Bank of America, with the analysts citing concerning volume trends for the packaged food industry, adding sales have barely improved despite the hopes that government nutrition assistance programs in a more promotional environment would provide a lift. That lift not there, not for the stock as well. Down about 2% here on the day. And finally, let's take a look at Carvana. Needham actually sending Carvana stock into overdrive on the day with an upgrade to buy and a new street high price target of $160 a share. The firm saying that the online used car retailer has room to grow both car sales and industry share by leveraging their online experience and an underutilized physical footprint. Those shares up about 3% here on the day to 129.43, and those are some of our top calls. We're going to stick on that last one, though, because at 129.43, that really doesn't tell the whole story. This was a stock that had plunged 98% from its all-time high to less than $4 a share just about a year and a half ago. A huge rebound, more than 3,000% higher off those lows. Chris Pierce joining us right now, senior analyst over at Needham. And Chris, while that 3,000% gain off those lows doesn't even get it close back to its all-time high, it's a remarkable turnaround. And I'm wondering what you think is really fueling that turnaround beyond just investor optimism.
Oh, I mean, I think you've had we've had a 9-month, I would consider a halo effect here. We've had the debt restructuring. We've had them show positive gross profits per unit. We've really seen Carvana become the company that people thought they could be in 2018, 2019. It's just been a rocky road to get here. I don't think anyone really doubted that they could sell cars, but it was about putting the plumbing in place to sell cars at a positive, with positive gross profits per unit. And they've hosted investors at their IRCs recently. They've shown that in their KPIs that they've reported. So you've got a company with, arguably the best mousetrap, with 1% share in a fragmented industry against a potential cyclical recovery in used auto, and they're showing that they put the plumbing in place to profitably sell cars. And they have a high fixed cost base, so within OPEX. Yeah. So as you see them shift towards growth, and as you see consensus unit estimates go higher, you're going to see a high flow through to adjusted EBITDA, and we think the stock can move higher as they grow share within used cars.
So are you looking at the balance sheet now in a more positive way? Because that was a big impetus for that 98% sell-off we saw, was everyone was looking at that balance sheet and saying, this company can't survive.
Yeah, I think that was the story, maybe we'll call it 9 months ago, when they got the debt restructuring done and pushing out some of the payments. But even that, they were when they did the original deal to buy the ADESA transaction, Bears highlighted how they had to do payment in kind. The lenders didn't think they could make the cash interest payments. They still have some payment in kind, payments that they're making. But overall, with the debt restructuring and, the growth of the business, the balance sheet is improved and it's potentially improving, because now you've got a business that people are pointing towards growth. They're pointing towards an industry recovery, and they're paying high single-digit, low double-digit interest rates. and they'll likely be able to refinance these rates in the coming years. Never mind the business flow through just in the used car business from lower interest rates.
Well, that's what I was going to ask, Chris.
The balance sheet is a back burner concern now, I would say.
Well, Chris, to that point, if you have the Fed cutting rates, like what kind of tailwind? Like, can you help quantify if we get like 75 basis point of rate cuts in the next like 6 months?
I would say that we're sitting, if you think about used autos as a monthly payment that people are buying, used auto payments have not gone down at all, even though we've seen modest price decreases across the used auto space because of the Fed interest rate hikes from earlier. So we're sitting in a situation where new car supply is high. We're going to see more incentives from OEMs. We're already seeing that there. As new car prices come down, that puts pressure on used car prices, which will help drive units. But the interest rates, specific to quantify, harder to say, but I would say that you've got a number of tailwinds to grow used auto units overall within the industry, a cyclical bounce there, but you've got Carvana as a secular share gainer within that cyclical bounce with their online mousetrap.
Okay, so yeah, secular shift for there as their upside, and they'll take advantage of the cyclicality on the upside as well. How does their inventory look like right now?
They've been growing it modestly. If you look at third-party data and things like that, it's hard to gauge inventory now versus inventory, we'll call it in 2021, 2022, because at that point in time, there was a mania for used cars and used car values were moving higher. So, I think it peaked around just over $3 billion, and now it's somewhere around 1.15. But, they have the floor plan capacity to grow inventory, and growing inventory is actually a bullish signal because the more inventory they have on hand, the higher conversion they see. So that's something that I think investors are viewing as a potential, signal that maybe they're going to hit the growth lever at some point in the next 6 months, 1 year. Explicitly timing that's been difficult, but really they put the plumbing in place to profitably sell units. So when they do hit the growth lever, we're going to see a high flow through to adjusted EBITDA.
Just real quickly, we only have about a minute left here, Chris. I am curious about that acquisition they made about a couple years ago here of Odessa and the expansion of their physical footprint. And I know there were some technology components that went into that deal as well. Has that already shown up as something positive or accretive for the company?
It's funny, if you look back at that moment in time, the deal was just done at a historically bad time with the benefit of hindsight. Used car sales were peaking, interest rates were about to go up meaningfully, but now that they've kind of refinanced the debt and can look forward, you've got this unused capacity where Carvana, they're now within 100 miles of 78% of the U.S. population. It used to be 32%. So that's how they can ramp same-day delivery. And they have this underutilized capacity where they could 3x the number of cars that they're running through their reconditioning centers right now. So that points to, growth going forward when they are able to fully utilize those assets.
All right, Chris, thanks a lot. We super appreciate it. Chris Pierce, senior analyst over at Needham, joining us there. And if you were
have you ever used that, like the little vending machine thing? Was like a novelty? Is that?
No, I've never used it.
So do you get your car you have to use the vending machine or something, or?
Well, I think they bring it to you.
Oh,
they bring it to you to test drive, like one that's like it, and then you buy one, and then they bring it to your door. Like, it's just easy access. You don't have to go to a dealership or anything. They just drop it off. Here are your keys. There you go.
Okay, interesting.
Also, if you're keeping score, by the way, it's 1-1. Netherlands and England. We're about 30 minutes in. We're 30 minutes to the closing bell. They're 30 minutes into the semifinals. If you're keeping score, it's 1-1. Netherlands versus England. All right, coming up, we're going to get insight on the state of the credit market with Lauren Basmadjian, global head of liquid credit at Carlyle. 90 minutes. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. And it is still risk on. You're looking at the S&P over 5,600, another record, yada, yada. Looking at 37 so far this year.
Yeah, I mean, this is good because I bought that 5,600 hat a few weeks ago. And
where is it?
I'm glad it got paid off. I forgot to bring it today. I didn't think it was happening today.
Yeah, what's the point there?
I know. I just keep this at my desk.
Well, no matter what's happening in the actual equity market, you still get calls and worries about bubbles in private equity. We talked about that yesterday. And the latest is PIMCO today warning that the credit market returns are failing to compensate for risk. CIO of Core Strategies over at PIMCO wrote, liquidity premiums have compressed in both public and private credit markets, with lower quality segments of each facing elevated vulnerability to economic slowdowns and higher interest rates. So we wanted to talk to a very big player in the liquid credit market. Joining us now is Lauren Basmadjian, global head of liquid credit over at Carlyle. Lauren, thank you so much for joining.
Happy to be here.
You guys play really big, whether it's direct lending, it's high yield, it's leveraged loans, CLOs. What do you see? What do you think in the market right now?
So you are still getting paid 8 to 9% for first lien floating rate risk to large corporate borrowers. We're talking about borrowers with $850 million EBITDA on average. So I actually think you can get good value in the liquid credit markets. What we're seeing in the fundamental performance, and think about our market, most of these are private borrowers. You don't have access to that information, but we lend to over 600 US companies, over 200 in Europe. So we have some differentiated data that we could take a look at. And I could tell you that we're seeing the highest percent of our companies grow EBITDA than we've seen in 2 years. So since Ukraine, when things started to change, EBITDA is growing faster than sales. We're seeing companies focus on free cash flow. And why is that? Because rates are higher, and they've accepted that they're going to live in this higher for longer rate environment. So we're seeing record numbers of our companies produce free cash flow even in the higher rate environment.
What about actual sales? Like, do we care about sales? Like, are we gonna, like, is that a worry, or is it just, okay, they're growing their EBITDA, it's all right?
You care about sales if you're going, if they're telling you you're going into a recession, but sales are slowing, and that's true. So we're seeing a slower pace of sales growth and your EBITDA growth, but that makes sense to me because companies are focused on profitability and cash flow.
Well, let's talk about defaults for a second here, because there's been a lot of discussion here about why we didn't see higher default rates, whether that was kind of a head fake, or and whether that's kind of still kind of the boogie monster out there. Are we kind of past that point where we should be assessing over default rates?
I think so, unless we really go into a deep recession. So default rates, there were all sorts of very high projections out there. We're at 1% as a market. That's much lower than long-term averages, which are between 2 and 3%, depending on the time frame you're looking at. I think the loan market is very bifurcated, though. So you could have, you see most of our companies that trade around par, meaning there's not really problems in those credits. And then you have about 4% of the market that trades under 80. And I'd watch that for more signs of stress. But again, that's the lowest it's been in 2 years. It has come down since Ukraine.
So when we talk about the favorability in terms of pricing, and obviously with the spreads that we see in the secondary market here, are we going to see that also improve, given that it felt like everyone was pricing in gloom and doom, I don't know, maybe like a year ago, and obviously that didn't materialize?
Yeah, so there's a lot of refinancings in our market, which means spreads are coming down. Performing credit is going to be able to access credit cheaper.
What about banks reporting on Friday, right? We're all going to be looking for that investment banking revenue. Like, we know the fees and underwriting and all that, but it's about M&A, right? Is it going to come back? Are the banks going to make money from it? And does that mean we're going to see a lot more leveraged loans and a lot more borrowers in the market to pay for all the M&A? Is that going to happen?
So there's a lot of leveraged loan activity, but it's mostly refinancing. So net volumes are not up. As far as M&A, there should be an increase this year. We're starting to see trickles of that in the leveraged loan market. There's stability in the market. Financing markets are wide open. So if you want to acquire a company and use loans to back it, it's available to you. That said, rates are high, right? The all-in cost of debt is high. So I don't think you go back to an environment like 2021 where you had record M&A, but we should be busier with M&A than we were last year.
If you see the Fed cut like 50 basis points, 75 basis points, does that change? How does that change the landscape then?
I don't think 50 basis points makes the big difference. I think it's the expectation for continued cuts. When you're running your models and you're thinking that your cost of interest is going to continue to come down, I think that's the difference.
I do want to talk about this idea of portfolio allocation. And there was a lot of discussion over the last years about how some of the institutional interests had maybe tapped out or at least reached an allocation level. They were bumping up against their own internal limits. And there was a much more of a focus on moving out to wealth management, the high net worth individuals. Are you seeing more appetite coming from the retail side relative to maybe what we saw on the institutional side a few years ago?
Yeah, I'd say two things. One, CLOs are returning cash. So it's an asset class where there's actually still demand because they're getting back their money. And two, we've seen a record year of retail demand for CLO product and floating rate product, which makes sense because rates are higher and you're getting a floating rate product. I think it's the first time we've really seen some democratization of institutional product in the CLO market finally being offered to retail investors.
Are you worried at all about the regulatory environment around that? Of course, as more retail investors get involved, not just in CLOs and some of the other areas of alternative investments, folks in Washington start to get a little antsy and they say, okay, is this too risky for those types of folks?
What's great about CLOs is they have a 25-year track record and they performed as advertised through every cycle.
So, but to that point, you know, there was an article on the Bloomberg terminal that also talked about double Bs right now and how there are tons of tourists now in the market. And if the liquidity dries up, the tourists are going to get like caught with their pants down. The article didn't say that. This was just me like encapsulating the idea. Would it be the same for CLOs? Like, are the retail guys tourists, and is that kind of a risk if liquidity does dry up?
You could certainly see outflows. I think some of the biggest inflows have been into AAA product, which is a very, very stable product. So if you saw a lot of outflows, could that get a little more volatile? Yes, but I think the institutional demand will be there to buy the paper.
So I'm asking for a friend. If I have money in a money market fund yielding 5%, I don't know what to do with it. What should I do with it?
So
it's a friend. It's not me. It's a friend.
We're seeing value really across the liquid space right now. I would talk about CLO double Bs. CLO double Bs today are paying about 12% current income. If you compare that to something like high yield, which is closer to 8%, it would have a better total return, a better current coupon, better Sharpe ratio. I think there's good relative value there. And then I look at CLO equity, and we're seeing some of the highest cash distributions than we have since 2015, which also seems like a compelling opportunity.
All right, great conversation, Lauren. Really appreciate you stopping by. Lauren Basmadjian, she's the global head of liquid credit over within Carlyle's global credit platform here. And Alex, this gets to the idea. I mean, the retail side, I've been fascinated by it. We've talked a lot about this with some of the private credit and private equity allocations now shifting more to the retail side. And of course, now you're seeing the same thing in the leveraged loan market.
And that really, and I do have the question, if you have $6 trillion in money market funds, does that belong to somewhere else? And if it does, where does that go to? Or is that just like basically a savings account now that you're just keeping in a high yield market, basically?
Yeah, well, it's going to go somewhere eventually, right? I mean,
does it?
Yeah, I mean, look, they're not going to be getting 5-6% forever, right? So at some point, I mean, it'll have to find a home somewhere else, you would think so. And, maybe it goes into some of those areas.
It'll be interesting to see.
Interesting to see as well. A great conversation about what's going on in the private markets. A discussion up ahead. Back to the public markets with Apple in focus as the shares now setting up for yet another record high. We learned a little bit earlier that the company is ready to announce big plans to ramp up shipments of iPhones. We're going to break down exactly what's going on. That's coming up next in our Stock of the Hour. This is The Close on Bloomberg. Time now for our Stock of the Hour, and we're watching shares of Apple up for yet another day, up to yet another record high. This after reports that the company is said to have told its suppliers and partners that it's targeting about a 10% growth in new iPhone shipments when that new one drops later this year. Abigail Doolittle joining us right now to talk a little bit more about it's probably one of the more, I guess, stealth rallies in the market right now. I was just looking, you go off that April low that Apple hit, they're up 40%.
It's incredible.
Since then, which for a company of this size, that's a phenomenal run.
It really is a phenomenal run. Although, as you say that, I think of another stealth rally, Tesla, in 2 weeks up 40%. So there's a lot of liquidity in the markets right now. But this one really caught me by surprise. I haven't looked at this chart in probably 2 weeks. To see it above 120 or 220, excuse me, just really, really surprising the way that this has gone up 7 days in a row. The funny thing is, though, that's the longest winning streak only since the beginning of June. So there really has been this incredible rally. So now we actually have this fundamental news, because if you recall, into the April bottom, it had actually basically been in a bear market, and it seemed to be a funding short for other big tech names. And the question was, why is the stock going up so much now? There was some excitement around Apple Intelligence, but if they really do deliver 90 million iPhone 16s sold by the middle of September to the end of the year, that is impressive. 10% growth, better than last year. It's all an AI bet, which I did dig in on this. So it's going, I did.
Okay.
So it's going to help summarize text. It's going to create original images and retrieve the most relevant data, plus a revamped Siri. For me,
a revamped Siri.
I would actually
I would buy
turn
for
that
the
off.
Siri.
Oh, you would? I've never used Siri.
I don't use Siri that much because I just
that.
find it unreliable. So if they can make Siri better.
Well, so maybe that will be a driver, because they really are expecting, this is one of the demand drivers that they're expecting. But the other thing is the numbers. You know
what could be a driver too, which bite out? My son dropped his phone yesterday.
Oh, did it crack?
But don't you have the cover part? Like the really thick?
He's a teenage boy.
Do you throw it against a wall?
I don't ask those questions. He just says it broke and I need a new phone.
So is he getting an iPhone 16?
I know. I think he's going to get a Motorola.
I was going to get the iPhone 16.
Yeah, exactly. But none of this addresses China and sort of the slowdown of Apple sales in China.
Yes. Well, it's interesting because earlier this year, the China sales were super, super weak. And then coming out of April, because of discounting there, they've actually improved. But there's other issues there. I mean, I remember stories not so long ago, government agencies and agencies in China not allowing workers to bring their iPhones to work. And then there's concern around what will Beijing's policies be around AI. They may actually not be able to put the AI into the iPhones that will go to China. So some questions out there. I personally would prefer to be able to turn the AI on or off. So maybe that would be a solution. I'm sure that they could potentially do that, but most people are going to want it.
Well, I do hope they bake that in there because that's a big concern. And not just with the phones, but we've seen this with the new Microsoft computers. There are a lot of people saying, how do I not have this? I want the computer, but not necessarily a Copilot and some of the other stuff.
Can you not do that right now? Can you not turn it on?
I don't know the answer to that question. That's a good question. But it seems, just based on what I've seen online, it's kind of baked into the system. But that's another story.
All right, well, at least, so you're going to get the phone.
Well, unfortunately, it's also, and he's not watching, it's also, a tracking device for, his parents. So, that's really the impetus to keep him tethered to that ecosystem.
All right. Yeah. Abigail, thanks a lot. Super appreciate it. My phone stops working every day.
Yeah. Speaking of which, let me see where he's at right now.
Fair enough. Apple at a record. You also got Google at a record as well. So all that Mag 7 aside from NVIDIA continuing to sort of grind their way to those records.
Are you an iPhone person?
Yeah.
Oh, you are? Okay.
I am an iPhone person.
Yeah.
But I resent it, but I am one.
You resent it?
Yeah, because they force me to keep buying the products. Yeah. And it's like, what if I wanted to change? I can't change. Anyway, just if you're keeping score, it's tricky. Yeah.
Netherlands,
England, still 1-1, you guys. We're 45 minutes in, and we are 1-1 Netherlands.
How long do these things go? 45 minutes?
90 minutes. We have 45 more minutes to go.
90 minutes, but I feel like you brought this up like 90 minutes ago. Is it still going?
Yes, I brought it up at the top of the hour, and then at the bottom of the hour, and then now I'm keeping you guys checked. All right, coming up, we're almost to the close here. Dan Suzuki is Deputy CIO over at Richard Bernstein Advisor. Today going to be joining us for his take on the markets right before CPI. This is The Close on Bloomberg.
Well, I first of all think that there's so many high expectations built into some of those tech stocks. And so whether the market can sustain this rally, I think has everything to do with those stocks. The overall volatility still looking so low when underneath the surface, there's so much more volatility in the individual names. The dispersion we're seeing is pretty unprecedented.
Heather Brilliant, the CEO of Diamond Hill, kicking us off to the close just about an hour ago. That dispersion she's seen, that volatility she's seen under the surface, at least for right now, working in favor of stocks. Romaine Bostick here alongside Alex Steele. Scarlett Fu joining us a little bit earlier than she does to help you take us to those closing bells here. And it's a pretty decent rally. We kept talking the other day. I know, Scarlett, just yesterday we were talking about yesterday's record rally, which was like 0.1% gain on the S&P. Today, we got some real upside moves.
Yeah, it's surprising, right? I mean, given that Powell didn't say anything different, but we're getting ever closer to that CPI report and the start of earnings season as well, where the rubber really hits the road, or meets the road. It's
either one. I think it's fine. Meets the road, I think.
Meets the road.
But individually, there were some really interesting moves. We were just talking about Apple doing really well, but Visa getting a downgrade. Deckers, also the worst performing stock in the S&P. Apparently, their Hoka and UGG sales are sort of question marks there. And Intuit also doing pretty poorly, and that goes to your theme yesterday, Romaine, of the application software name. So under the surface, interesting stuff.
And and I'm glad you brought up the Deckers thing, because that really shocked me when I saw the shares dropped. And you're kind of like, what's going on? But this gets to that consumer spending story as well. Now, is that Deckers weak because people are still spending on shoes, just not on Deckers? Or is this really a story about consumers just kind of pulling back?
Yeah, and that's going to be the big question when we hit earnings season, and how the CEOs are going to really frame what kind of demand they're seeing and how they're preparing for whatever the consumer does do going forward.
I mean, from what the analysts say, it really is just a product thing.
Yeah.
And we see that with Nike, right? Have the right product.
All right, well, let's bring in let's bring in Dan Suzuki, Deputy CIO over at Richard Bernstein Advisors. I know, I was reading the wrong thing. Dan, it's good to see you. Thank you so much for joining us. So we talked about the S&P 500 at record highs, topping 5,600. Is this buy on rumors, sell on news once the CPI numbers come out and once earnings season begins?
Yeah, I don't know. With regards to CPI, I don't think it's going to be a huge surprise. So I think, right now, the path of least resistance is for inflation pressures to come down, and I think earnings will come in pretty good. And I think that's pretty supportive of markets here. The one fly in the ointment is that we've had this incredible run of liquidity. If you look at the pull up the Bloomberg Financial Conditions Index, we're at the high end of the historical range. So, that's difficult to predict when that's going to pull back. So I just think you need to be careful because the mix of earnings is changing and liquidity, you just have to be careful.
I do want to talk about kind of those idiosyncratic stories, particularly with the start of earnings season. I know the macro is still driving things, but we've heard a lot about this idea that this is much more of a fundamentally driven market and, more importantly, a market driven by individual stocks rather than an aggregate. Do you think the earnings season is going to support that or maybe push back against it?
Romain, that's a really good point because I think there's going to be both. Right. On one hand, this may be the most desynchronized profit cycle that we've seen in decades. You have a lot of sectors and parts of the market that are accelerating. Some are peaking out and rolling over. So to that end, it's a sector-specific story. It's a company-specific story. It's a good-specific story. There's a lot of different dynamics happening, which makes for a great opportunity for stock picking. At the same time, though, I do think the other thing that you're going to see this earnings season is a broadening out of growth. And so you're going to see it at the sector level. More sectors will be improving. Regionally, you'll see more areas improving. And companies, you'll see more companies putting up faster growth. So I think the macro may start to take hold more as you get later in this year. But for right now, I think it is very disparate.
So what sectors do you like based on that?
Yeah, well, I think if you believe in the broadening out of growth story, then there's a huge number of opportunities because no one's wanted to own any of these stories because their earnings have been weak. So if their earnings are going to start to get less bad, their earnings are going to start to get better, then there's a lot of opportunities. So I would say own the cyclical sectors that are going to be accelerating here, and not just sectors, but regions as well. So emerging markets, I think, is going to see earnings acceleration. I think hopefully this quarter is going to be the first quarter where you see a meaningful pickup in small cap earnings fundamentals. Industrials, energy should see some improvements here.
That would be huge, though, if we get that small cap pickup, though, right?
We've been waiting for it.
Because that's the big component of this rally that's been missing, right?
100%. This has been a very unique factor. In the absence of earnings fundamentals, people have been just trading off of the Fed. Once earnings and operating leverage comes through, I think the Fed's going to take a back seat.
I think you put it perfectly, and I look at the economic surprise index and how it's gone down, 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 and the S&P 500 moving in the inverse, which is up, 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 up. Once we start to see economic surprise index kind of turning the corner there, and inevitably it will happen because it's self-correcting, do we get the knee-jerk reaction of the market leveling off then?
Well, I think it's really a mix issue, right? There's certain areas that have benefited from that dynamic as people flee toward higher quality companies, towards safer companies, toward the companies that have earnings growth today. And it may just be a switch where people move into the stocks that are actually starting to improve that they've shunned before. So at the index level, it may not be a huge upside story, but within that, there could be some pretty big C shifts.
You mentioned some of the cyclicals. Does that include financials?
That's an interesting question. I think financials should do fine. Is it
fine? I hate the word fine.
Well, it's part of financials, so I had to work it in somehow. I love puns. But no, I'd say there's pros and cons. I think if the economy is doing okay, there's going to be more demand for loan growth, et cetera. But I think the consumer, which has been sort of the shiny star in the economy, is slowing. And with that, you're going to see more credit risk and credit defaults and delinquencies and issues. So I think there's just going to be more of a pros and cons versus some of the areas which have more just pure upside.
Well, I mean, if we talk about a slowing consumer or a softening consumer and I guess consequentially a softening economy, then why are people still so optimistic, not just about this year, but really heading into 2025, at least when it comes to equities?
Are they optimistic? I mean, I guess it depends on what numbers you're looking at, who you're talking to. You look at the consumer surveys, I mean, clearly there's a lot of concern out there. But I think that there's been a huge disconnect between profits and the economy. Last year, the economy was rocking and rolling and profits were just starting to pick up. Now you have an economy that's starting to slow and the profits are continuing to pick up. And I think that's really, if you break up what drives the S&P, it's very different than GDP, right? It's much more about goods, trade, manufacturing, and exports, whereas the economy is the consumer. So if the economy slows, I think there's still a lot of areas where beaten up companies with beaten down profits can improve here.
How closely are you paying attention to what's going on in politics? I mean, clearly we're following.
It's hard to avoid.
But I mean, clients must ask you about this.
Yeah. Clearly the market's going to trade. The closer we get, the more volatility you're going to see as people sort of price in these things. Does it actually matter in the long run? I point out to people all the time, if you knew President Biden was going to get elected in the last election, you would have sold all of your energy stocks, best performing part of the market. With Trump, you would have bought coal and steel and energy, and that stuff did horribly. So I don't think it's a good idea to trade on it. And at this point, it's also different because the last time when Trump was elected, there was corporate tax cuts were on the table. This time, you're choosing between tariffs and taxes, and both sides are going to spend a lot, so it's not going to help the deficit. So I think the implications for the market are going to be a lot less clear and a lot more straightforward. And even if you do know, the market usually doesn't work out that nicely even when you know what the policies are and who's going to win.
We're just a couple minutes away from the close here. We're looking at the best winning streak for the S&P 500 since November of 2023. We're spiking into the close, the whole thing. How much more upside do you think we can really grind out on an index level?
Yeah, so again, I think the index level is more at risk, right? Because liquidity's been a big driver. We're kind of stretched on that front. And earnings growth for the big drivers of this market are actually starting to slow. And so from that vantage point, I think there are some risks at the index level. So I would be trading within it. To Romaine's point about being a stock picker's market or being choosy about what you own, I think this is the time where things are inflecting to do that.
I just want to say, Mark, this was a great conversation.
Thanks
a lot.
Always appreciate having you on.
Thanks, Christine.
It's not Mark there. This is, nevertheless, the one and only Dan Suzuki, Deputy CIO over at Richard Bernstein Advisors. With just about 1 minute until we get to the closing bell, and we talk about this streak here. I was just taking a look at the intraday chart here. We're hitting session highs as we speak here. Also kind of interesting, though, too, I think this is the first day in a long time that I can remember where every single major U.S. index was in the green.
Yeah, I was just looking at that too.
Because the Dow has kind of lagged quite a bit as tech continues to kind of grind its way higher, but it's only been led by like an Apple situation.
Yeah, and the Russell 2000 above 1%. How often can we say that? The last time that happened, by the way, the biggest gains since June 12th, so about 1 month.
Yeah, it's basically 1% across the board for all these major indices. And again, that's kind of in tandem because it seems like every time we would get these rallies, it was sort of one or the other. You would either get the NASDAQ and the big tech kind of moving higher and the small caps and everything else moving lower, or vice versa. At least for one day, we get a taste of maybe what the bull market used to look like here, which is 1% gains across the board. Green, indeed, across the screen. You pick an index, it is probably higher on the day. The Dow Jones Industrial Average up about 400 points, or about 1% on the day. The S&P up about 57 points, or 1% on the day. And yeah, indeed, that is a record high, 56.3381 as we wait for those numbers to settle. But no matter where they settle, there will be a record high in the first close above 5,600. The NASDAQ Composite and NASDAQ 100 each up about 1% on the day. And let's take a look at the Russell and the small caps. The Russell 2000 up about 1.1%. We should point out S&P 400 mid caps up 1.2%, and Dow Transports also in on the action, guys, up about 0.7%.
Okay, so you say you pick an index that's probably higher. That is the case for all 11 sectors in the S&P 500. When I checked earlier, there were a couple of laggards here, but the worst performing sector is financials, and that's up by 0.4%. Consumer staples up by 0.5%. These are the laggards. These are the weak links. The best performing sectors, technology, and that's really driven by the chip companies, up about 1.7%. Materials higher by 1.4%, and healthcare gaining about 1%. And notably, when you break down the Russell 2000, the best performing group are the financials.
Financials?
Yeah.
Interesting.
Well, that's kind of fitting, I guess, heading into effectively what is the start of earnings season in a couple days.
Okay, and taking a look at the bond market, headline level, it's terribly unexciting. You're looking at a little bit of a bid into the bond market, particularly in the back end, with yields down by about 1 to 2 basis points. But what I find so interesting is you had the 3-year auction yesterday, super solid. Then you had $39 billion of 10-year bond sales at 1 o'clock today, super solid. And then tomorrow you get $22 billion of 30-year. That's going to come at 1 o'clock tomorrow. And if trend continues, that should be relatively solid as well. So, and I keep saying it, that whole idea that eventually there'll be no buyers for all those bonds the government's issuing has just not happened.
Yeah, absolutely here. And we talk about maybe a bond market that could get reawakened on the back of that CPI report coming out 8:30 a.m. Washington time tomorrow morning. And of course, earnings season also kicking off in the morning with earnings out of Delta, the big banks on Friday. Let's get some insights into what's been going on in the market today and what could go on in the market tomorrow. Bailey Lipschultz and Jess Menton, the best of Bloomberg, joining us here at the desk here. Bailey, I'm going to start with you just because the teleprompter tells tells me to. I don't know why.
No, also, he just got married.
I did just get married.
Well, congratulations.
And he's been gone for 2.5 weeks.
But we talk about what's going on in the markets and this idea that we are, at least for one day, I should say, we are seeing more of a broadening of this rally, a rally that's been kind of confusingly persistent, right?
Yeah, we're continuing to move higher when you look at the record high after record high after record high, seemingly, at least when you look at today, though, driven by chip makers, driven by that Apple news. So when you're looking at some of the better performers, or the top performer in the NASDAQ 100, Illumina, in the gene sequencing space, up 6%. We're seeing kind of a broadening of this rally, as you mentioned, Illumina having its best day in about a month, but top performer in the NASDAQ 100, expanding its offerings there. Also want to look at, as I mentioned, Apple aiming to ship 10% more new iPhones in 2024. I personally want to know what that means for me because I upgraded a couple years ago. New AI features, maybe I have to spend some more money. But also, again, when you're looking at
you
some of those...
You want these AI features?
Well, see, the thing with Apple to me is the second and third generation's where it's at. So maybe I won't get the 2025 upgrade, but 26 and 27 I'll end up spending like $3,000.
But we were talking earlier about, like, do you want an opportunity to turn on and off the AI features?
You want to opt in or do you want to opt out?
Opt in or opt out?
He's opting in.
I'm probably going to opt in.
He's opting in.
I also like Apple makes everything so easy. So if it's going to be fluid for me and it makes my life easier,
well, sort of, except for iTunes. That's dead to me.
Yeah, that's true. iTunes is all kinds of problematic.
What else are you looking at on the upside?
Well, so when off that Apple report, we saw Qorvo, we saw Skyworks, a number of other kind of suppliers rallying today, and also big data, big release from Taiwan Semi. That really sparked a rally for those chip makers overseas. You're seeing demand for AI infrastructure. That's really kind of driving the further leg higher when you look at what moved the market today on the MOV function. NVIDIA accounting for 10 points in the S&P 500, Apple 7.4.
I'm always wondering why we didn't see more of a lockstep in Taiwan Semi with NVIDIA's rise. I know they got a little bit of a bump, but it wasn't necessarily one for one because, pretty much, NVIDIA is relying on Taiwan Semi and Samsung to that matter.
Yeah.
But obviously Taiwan Semi is a big beneficiary of all these gigantic chip things that Jensen Huang.
And there are all these little dynamics that you have to keep in mind too, right? The trading between the ADRs and the underlying stock in Taiwan. Taiwan Semi actually is going to be reporting earnings, I believe, sometime next week. That'll give us an early read on what the AI chip demand looks like.
All right, well, let's get to the decliners. So that's the upside. Thank you, Bailey. The downside is Jess. All right, Jess, so what are you watching? What was on your list today?
Well, I have to point out Deckers because this was the biggest percent decliner in the S&P 500 today, down about 5%. So this was its worst day since April 25th. It actually had a warning from M Science, a research firm that had kind of a downbeat note when it came to the footwear company, talking about how it saw a notable deceleration in some of its Hoka as well as UGG sales. But I have to point out, I don't personally own any sort of UGG shoes.
Scarlett owns like 20 of these things, so I guess she's not spending
anymore. June is kind of a weird time to buy them. I don't know if people start loading up on those early ahead of the winter months.
It is counter-cyclical buying. You buy in the summer when they're sales.
But have you seen the
Uggs? You know what? People aren't apparently buying them.
I see people wearing those all the time, like the little low top.
You know, I love when it starts to get a little bit cooler and people start bringing it out when it's about 60 degrees in September. People start bringing out the Uggs.
I don't understand what's wrong with this.
So are you one of those, Alex, that does that?
Yeah, but you don't want to bet on what I buy. That's sort of a bad mix. What else you got?
So another one I'm looking at is also CrowdStrike. So this was the worst performer in the NASDAQ 100, down about 3% today, worst day since May 30th. That's actually the third consecutive day of declines. If you're looking over at IGV, so that's if you're looking at the ETF that's tracking more of the software companies in the S&P 500. So you're seeing other companies as well as Salesforce, as well as Snowflake that are kind of coming down with that. But we saw a rotation at the end of last month where money was flowing more into more of the software type names rather than what was happening obviously with chip stocks. But we're seeing a bit of a pause right now. So you're seeing that pressure CrowdStrike today.
All right. What else? Intuit. I was mentioning Intuit earlier. That was quite interesting.
Well, that's also the parent company, as we know, when we are talking about TurboTax. So actually, when you're looking at this stock, down actually about 2.7%, worst day since May 30th. It actually has plans to cut about 10% of its workforce, or about 1,800 jobs. But what's interesting about this, because when you think about a lot of the cost-cutting efforts from big tech companies over the past couple of years, this company's actually been more shielded to that. But what's interesting about this is that this had to do with what they were calling maybe underperformers at the company. So they cut about 1,000 of those positions, and they plan to rehire roughly a similar amount because they want to actually create more jobs related to AI, because they feel like they need to get kind of on that bandwagon against some of its peers as well. So that's why you are seeing that, even though, I mean, this initial drop in the stock, though, but we'll have to see where that stock goes from here after those.
Will all that AI make their tax prep cheaper?
That's the million-dollar question.
No, but probably for a small business, it'll be easier. But for you, they're like, oh, we don't care about you guys.
Or you can just go with the government website and, use the software that they provide there, too. But
what?
Yeah, I know.
That feels
like, no.
really inefficient. I do not want to do that.
Okay, so those are gainers and decliners on in today's trade, which of course, big gains across the board when you look at the major indexes. One story that really caught my eye today is the latest census report shows that the New York City kid population is down 18%. I bring this up because both of you live in the city and both of you have kids under 18.
So, I'm sorry, where are these kids?
They moved out to the suburbs,
Have
apparently.
their parents gone with them?
Yes.
Oh, okay.
So
there's an 18% drop in
Yeah.
parents as
or
well.
are they just having less kids?
Yeah. But
yeah,
is this,
that might be it too.
What's driving this? Is just like cost of living or
cost of living is a
life?
big one, and just the pandemic changed
Yeah.
the way we all think about living in the city, and people moved out, and perhaps they didn't come back, or the ones who stayed, have fewer kids.
Yeah, every now and then I go outside the city. It's nice. Yeah, particularly on a 90-something degree day when really the odor's here. Oof.
No way.
Alex, not a fan?
No, I was born in New York City. You can't leave when you're born in it. So apparently since April 2020, the under 5 population has now fallen by 18% in New York, 15% in Cook County, which includes Chicago, and 14% in Los Angeles. So it's not just like New York, it's like other major cities.
So
at the
it should
end of
be
the day.
easier for you guys to get your kids into those like after school programs and all the other activities, right?
Oh, that's
No.
actually a really good point.
No.
It's still New York City.
It's 50-50. It's
Right.
50-50. I live in Brooklyn, so it's different.
Oh, there you
50-50.
go. Oh, Brooklyn. Our thanks there to, we should point out our thanks to Jess Menton and Bailey Lipschultz here for sticking with us here at the close, walking you through all the numbers. But stick with us, a lot more coverage coming up here on Bloomberg Television as tech titan and media titans gathering in Sun Valley, Idaho for Allen & Company's annual conference. We're going to get the latest on what's going on out there, all the drama around Paramount and Skydance and the health of the advertising industry. Mark Douglas over at Mountain going to be joining us after the break. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic, a 7-day win streak for the S&P 500 to guess what, Scarlett?
I'm wearing green, so there you go.
Another record high. You wore the right shirt for this day here because unlike yesterday where we were all kind of poo-pooing that 0.1% rally, you got a much more meaningful advance today. 1% gain here on the S&P 500. Similar moves on the NASDAQ, the Dow, and even the Russell 2000 here on this Wednesday afternoon. The Philadelphia Semiconductor Index, tech stocks, chip stocks, what else? Of course, leading the charge. But this was one of the more broader rallies that we've seen, at least going back towards the end of May. A couple of weak spots out there that we should point out, including in the restaurant space with Darden and Bitcoin. Scarlett continues to remain on the back foot.
Yeah, but it was really tech that took this front stage, the center stage in terms of big gains. And you see that with Alphabet up by better than 1%. And this is the case across the Magnificent Seven space. But I do want to point out HubSpot losing as much as 19% earlier after Bloomberg reported that Alphabet has shelved efforts to acquire the company. Apparently, Alphabet was interested in a potential deal with HubSpot earlier this year, but the two sides didn't even get to the due diligence stage of negotiations. This is according to people familiar with the matter. Hawaiian Electric up by 21% on the day. This is after a local news outlet reported that a settlement resolving all claims and lawsuits over the Maui wildfires was progressing and advancing through the Maui County Council. So some good news for shareholders of Hawaiian Electric. But our top story this hour really comes down to inflation. Jay Powell says he is not ready to claim victory over it as the Federal Reserve awaits the latest read on consumer prices due out tomorrow to determine the progress of inflation moderating to its 2% target. Now, traders have already made up their mind. They're positioned for a dovish outcome, building their bullish bond wagers over the past week and a half. Later this hour, we're going to be hearing from the CFO of General Mills on how the food company has been addressing inflation. Romaine?
All right, but before we get to that, we do want to focus a little bit on what's been going on in the world of media and tech, because the titans of those industries, they're gathering in Sun Valley, Idaho right now for the annual Allen & Company conference. And of course, Paramount's merger with Skydance Media has been the talk of the town, to say the least. But don't forget, there are a lot of other players out there that have unresolved issues. That includes over at Warner Brothers and CEO David Zaslav, who's actually saying that Paramount deal is actually good for the industry. Mark Douglas joining us right now, President and CEO of Mountain, which builds advertising software for brands. He joins us right now to talk a little bit more about what's going on. Before we get to some of the advertising components of this, I do want to get your initial reaction to, I think this is a done deal. We'll kind of knock on wood for that, that this Skydance Paramount saga appears to now to have been resolved.
Yeah, well, I think obviously the deal is risky in the sense that Paramount is a company that's been hurting. So I think doing a turnaround is always extremely difficult. I think why someone might say it's good for the industry is because if you buy Paramount, you're going to have to really rebuild it around some specific set of content that people just love. I think in their case, it's likely sci-fi. They have, Star Trek and other shows on the channel. And that is probably going to lead to more acquisitions. And so this is the first of many, is what I would predict, in this saga, as you referred to it as.
We always talk about this Sun Valley conference, Mark. It's kind of, where deals get made. And I know the last couple of years, it's been a little bit more muted. And even this year, it doesn't really seem like there's a whole lot of loose ends out there here. But what's sort of interesting about these conferences is not just who shows up, but also who isn't there. And there's some notable names that we've seen in the past that have, for whatever reason, have decided to skip it this year.
Yeah, well, I think some of those names are Warren Buffett. Some of them are, Warren Buffett and Elon Musk, I think, are two of the most notable names that are not there. Elon Musk, I think, quite frankly, he's busy getting rockets going into space. He's also probably feeling a little beat up. I mean, I don't think there's many more questions he wants to answer publicly these days. So I think I'm not sure you can read too much into it. People are just really busy. It's a busy summer. There's a lot happening, in the business world, just all around. And I don't think there's anything more to look at other than, people have their heads down and finishing off what's really, for a lot of people, a really good year.
Yeah, and of course, we'll wait to hear whether there are any percolations of deal making or speculation of deals coming out of the conference as the week continues. Going back to Paramount and Skydance for a moment here, David Ellison calls Skydance a next-gen pure-play content engine and Paramount as a world-class storytelling enterprise. There's a lot of buzzwords in there, admittedly. Yeah. But for those of you in the advertising space, what does a reinvigorated Paramount that is backed by Ellison money mean for brands?
Well, I think the streaming world has been consolidating. So to potentially have a consolidator. So essentially what's happened is if you have brands that the consumer really understands what they represent, Disney and children's entertainment, ESPN for sports, potentially Paramount with science fiction, things like that, those are going to be the continued winners in streaming. And everyone else without that are going to be essentially acquired for their previous content library. And so to have, really deep pockets in the form of Ellison and, obviously his father is Larry Ellison, coming into this market potentially to become a new consolidator and build another tentpole around, really branded effort, I think it is needed in the industry. We need more than just Netflix and Disney and a handful of others there. So I think it's good.
We need more, but at the same time, there's a lot of weak streamers out there. Paramount has a couple of streaming services. You've got Paramount Plus, but you also have Pluto, which is free. What happens to something like Pluto?
Well, they're all being consolidated, I think. People the Pluto brand, as an example, runs independently just because it is free and it kind of represents that. But for the most part, I think the CBS brand, I think all of the original brands, CBS and ABC, are at risk of, kind of going like Oldsmobile, like you remember them, but they don't exist anymore. And I don't even think that's a possibility. I think it's likely. If I ask someone on the street, hey, what would you go to ABC to watch tonight? You get a blank stare. And so why does the brand exist? And CBS is like kind of on the cusp of that same answer. They're able to say sports, but I think people are hard pressed to say what else. And so a lot is going to be rewired there in order to, build a real brand that consumers understand.
Got it. Mark, really appreciate your joining us. Mark Douglas is president and CEO of Mountain as media titans gather in Sun Valley, Idaho. Just a quick headline here. The jury in the Bill Hwang trial on Archegos Capital Management will soon deliver a verdict on Bill Hwang and the CFO, Patrick Halligan. So when that does cross, we will, of course, bring that to you. In the meantime, we've got the top three, where we'll focus on the top three movers and shakers at the center of the day's big stories. This is The Close.
The jury in the Bill Hwang case has reached a verdict. We're just learning this, just crossing the wire right now. The trial of the former head of Archegos in that fraud trial. The jury has reached a verdict and will soon deliver that here, deciding the fate of Bill Hwang, who, of course, was the focal point of that breakdown of the family office of Archegos, the family office that had a lot of ties to other funds out there, including ARK Investments. Kathy Wood here, waiting to get that verdict at any moment, and we'll bring it to you as soon as we get it. Scarlett.
In the meantime, it is time now for the top three. We're going to name drop some folks driving some of the day's most talked about stories. And the first one who's up is Monish Patolawala. He is stepping down as CFO of 3M to take on the same role at Archer Daniels Midland. So he's going from one challenging situation to another, right? Because 3M, the company he's leaving, has all these legal liabilities from defective earplugs and Forever Chemicals, a change at the top. And then you've got the new company Patowala is going to, ADM, which has its own accounting issues.
Yeah, they've got a lot of issues. And so it's kind of intriguing that he would choose to take this on. But I don't know, maybe that's, you find opportunity sometimes in chaos. Maybe, we don't know his personal thinking, but maybe that's what it has to do with. I don't know if he has broader ambitions than this, but I don't know. I think if I was him, I would probably maybe just retire.
It's a good time to prove his mettle, right?
Yeah, absolutely. Person I've been keeping an eye on is the soccer player, Lamine Yamal. He's with Spain, and he became, yesterday, at the age of 16, the youngest ever scorer at a European championship. One thing that caught my eye on this is actually the picture you see on your screen here. You can't tell, but that little baby on here, that's him, and the guy sort of touching him there, that's Lionel Messi.
Oh my gosh.
16 years ago.
Incredible.
It's not quite clear. It sounds like there was some kind of soccer camp that his mother was involved in. And of course, I doubt Messi knew at the time that little baby would grow up to become, at least for today, one of the most talked about soccer stars.
Well, and there's also that link to Barcelona too as well, right? So Yamal turns 17 on Saturday. We know what he's going to be wishing for because on Sunday, his team, Spain, will be playing the final against either the Netherlands or England, and the game is still continuing. So it's what do you call it? A draw? A tie?
It's still 1-1?
It's still tied at 1-1.
So they haven't scored any more goals yet?
No, they haven't. They're, are they in extra time? I can't tell with these soccer games how long these things are supposed to go for.
I'm told 90 minutes.
Yeah, but then you add on for penalties and everything. It's confusing. All right, rounding out the top three is Jennifer O'Connor. She was named the new general counsel of Harvard University, which means she will lead the school's legal strategy through lawsuits and congressional probes over its handling of anti-Semitism on campus, and also calls to cut financial ties with military contractors. Speaking of challenging jobs, right?
Yeah, not one I would want to take either.
And she's got some relevant experience. Her last job was at Northrop Grumman, which, of course, has faced protests calling for divestment and boycotts of Israel as well. All right, let's, speaking of people who we're watching, a chorus of Democrats signaling unease with President Joe Biden. Former House Speaker Nancy Pelosi declined to support Biden's intention to seek re-election, saying instead that it remains his decision to make. Meanwhile, one of the party's biggest celebrity supporters and donors, George Clooney, is publicly calling for a new nominee. So let's bring in Bloomberg's Kailey Leinz for now. So Kailey, it feels like the momentum is definitely moving in the direction of something happening, and we know that the White House is going to be meeting with Senate Democrat leaders soon.
Yeah, campaign officials are going to be meeting with Senate Democrats on the Hill tomorrow at 12:30 p.m. ahead of Biden's high-profile press conference that he will be hosting in the evening at the NATO summit. So everybody's going to be waiting and watching for that. As to this point, it seems that he hasn't been able to stop the bleeding within his own party. Still getting this trickle of doubters, if you will, including George Clooney, who just weeks ago was fundraising alongside Biden in California, helped him raise tens of millions of dollars. Today saying at that fundraiser he saw the same man as in the debate almost 2 weeks ago. even though he said it was devastating for him to say that. We also had an 8th member of the House publicly calling for Biden to step out of the race. Democratic Congressman Pat Ryan of New York's lieutenant governor today, calling for Biden to step aside. And as you mentioned, Nancy Pelosi, when given the opportunity to endorse his reelection effort, declined to do so, just said it's his decision to make. And I would point out, Biden has already said his decision is made. He's staying in. So for the Speaker Emerita to suggest there's still a decision here suggests that there are different conversations happening behind closed doors.
Well, hang on. I mean, it's not Biden's decision to make. And ultimately, it is about his party's decision to make. And I am curious that as they sort of have to sort of wrestle with whether they have a better shot with someone other than Biden, are all of these folks asking him to step aside? Have they actually said who they want in his place?
No, that's an entirely separate conversation, Romaine. That's something else Democrats will struggle greatly with. I would just say that the delegates at the Democratic convention that ultimately will decide the nominee have been pledged to Biden, as he did win the Democratic primary. So he does have to decide he is exiting and tell those delegates to vote for someone else, for another nominee to be elected. So in some sense, this actually very much is up to President Biden, though influential members within the party, like Speaker Emerita Pelosi, the current leadership of the Democratic House and of the Senate majority, could exert some pressure on him, as it could members of his own family. Ultimately, it is going to come down to whether the president decides he's in or out, and tomorrow's press conference could be highly consequential in influencing that decision.
Yeah, I don't know whose idea that was. Kailey Leinz, you can go check her out at the top of the hour, Balance of Power. They'll have all the deep dive into all the big saga going on with the president of the United States.
Yeah, this even came up during the Powell hearing today, because some of the senators asked Powell what he thought of President Biden. He said he hasn't met with him for years, but he had not seen any meaningful cognitive decline.
Did you look at Powell, the hearing? He looked a little tired today himself. He looked like he was just like over it.
Well, I mean, it's been 2 long days, so in his defense. 2 long days of not saying a whole lot.
Yeah, and then being asked about something that you're not supposed to even talk about with the president there. All right, when we come back here, we're going to take a look back in history and the origin of the commercial space race and the launch of Telstar 1. Here's a question before we go to break. What iconic movie prop is said to have been inspired by the design of the Telstar satellite? The U.S. ambition to commercialize space is almost as old as the urge to explore it. But the historical links to today's commercial space race go back to this day in history, July 10th, 1962. That's when the Boeing Thor Delta booster rocket launched from Cape Canaveral, carrying AT&T's Telstar 1, the world's first privately financed satellite. It was big in size and in importance. The largest air-inflated structure ever made, Telstar was constructed of polyester and rubber, measuring 161 feet wide, 210 feet wide, 161 feet tall, with a 380-ton antenna embedded inside. Now, just hours after that launch, Telstar relayed the first ever live transatlantic television pictures. It was just a fuzzy shot of an American flag flapping in the wind out in Andover, Maine. But it was a major milestone that brought this expansive, disparate world much closer together. A breakthrough so remarkable, President John F. Kennedy predicted it would, quote, throw open to us the vision of an era of international communications. Telstar 1 relayed the first satellite phone call. It became the first to synchronize time between 2 continents and was the first to shuttle computer data by satellite between the U.S. and Europe. Telstar 1, though, didn't last long. It failed in December 1962, was restored, and then went dead again for good in February 1963. But the genie was out of the bottle by then. A second Telstar was soon launched, positioned further out in space, and at least 20 more would go up over the decades, with the last in July of 2018. And that brings us to our question of the day. Telstar made its mark not only on satellite communications, but also on pop culture, with its iconic geometric solar panels becoming the inspiration for the World Cup soccer ball and presumably for the Death Star space station in the Star Wars movie. Though we should note, film director George Lucas has been very cagey about where he borrowed that idea. Nevertheless, that story has held. As for Telstar 1, no longer in operation, though it still orbits the Earth to this day, a marker of a giant leap forward in how human beings connect with each other around the world, and a launching pad for what is now a multi-billion-dollar commercial satellite industry.
Dun, 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 dun. That's all I can think of. And I can't believe it still orbits the Earth. That's pretty remarkable. as we ponder that, of course, we're also keeping in mind what's coming up in economic data, and it is the closely watched consumer price index that is due out tomorrow. Economists surveyed by Bloomberg estimating that headline inflation fell in June year over year, but the core number, which excludes volatile food and energy prices, will likely be flat. So joining us now is Nancy Lazar. She is chief global economist at Piper Sandler. Nancy, it is so good to speak with you. The market has been pricing in a pretty dovish outcome, not just when it comes to CPI, but also with Chair Powell's testimony this week, where the market's pricing in 2 rate cuts this year, 70% odds that the first one would come in September. Does that sound about right to you?
I'm not convinced it's going to be September. We think by December, yes, but we're not convinced that inflation has actually been tamed as aggressively as perhaps consensus has now believes it to be. Even just today, we had a major retailer announce that they're increasing club fees by 8% because sales are slightly disappointing. And so companies are really trying to support their revenues by increasing prices. So no, I'm not convinced we see, or either as my colleague Benson convinced we see it in September, but most likely by December.
Yeah, you have Costco boosting its annual membership fee, Romaine. Executive membership fee goes to $130 a year from $120.
Yeah, exactly. Well, wow, aren't you fancy? The regular membership is now $65.
I'm an executive.
Start, but you're an executive. You're fancy. But yeah, a lot of people were expecting this year, and it gets to Nancy's point.
Absolutely. Yeah. So, Nancy, that being the case, it sounds like you're expecting the market to be surprised when the numbers do come out. Take us inside why you think inflation is still an issue and whether that'll show up in tomorrow's data or down the road.
Well, we think tomorrow's data were in line with consensus, 0.1, 0.2. There is a chance the 0.2 could be 0.3. And one of the reasons it could be is you are still seeing companies. I have a list of about 17 companies that have been increasing prices over the past 6 weeks, again, to support their revenues. Now I have 26 companies that are actually announcing price cuts. And so you're definitely leaning towards less inflation than more inflation. But again, there is the desire of companies to support their profit margins through raising price. So there is a chance tomorrow number it could be disappointing, be it Costco, as you just said. Also, you're having a lot of non-discretionary companies raise prices. We did see a sharp drop in auto insurance last month. Is that going to continue? You are hearing companies increasing insurance rates in California big time. So we worry about those non-discretionary price increases, which are lagging.
Sorry, Nancy, I'm just going to have to interrupt you for 1 second. In conversation with Nancy Lazar, chief global economist at Piper Sandler, we do have some breaking news on that Archegos fraud trial. A verdict is in, and that verdict is guilty. A guilty verdict for the CFO of Archegos, found guilty in that trial, and Bill Wang, of course, the co-founder of Archegos, also found guilty. This after that trial, of course, that captivated everyone, of course, with the big collapse, a collapse that took down a lot of folks with it. Vonnie Quinn, our very own Vonnie Quinn, right now, I believe standing outside the courthouse. Vonnie, what do we know?
So the verdicts are still actually coming in, Romaine. We have 11 counts. 3 of them are against both parties. The rest of them market manipulation counts on various stocks against Huang himself, but we have some guilty verdicts at this point. Count 1, we're still waiting for clarification on that. Count 2, count 3, count 4, count 5, count 6, count 7, not guilty. So we have at least 5 guilty verdicts right now. One of them against the CFO, Patrick Callahan at the time, and the others against Bill Huang, the founder of Archegos. Count 8 and 10 guilty. Bear in mind, this is a big win for Manhattan U.S. Attorney Damian Williams and the Southern District of New York, who pressed these charges after, of course, the whole thing came collapsing down in March of 2021. Bear in mind, this was a family office that Bill Huang, a tiger cub, had built up from a $200 million fortune to, on paper at least, $36 billion at its peak, on paper at least. Within a week, it was worth nothing. It was wiped out, and counterparties, including many Wall Street banks, were on the hook for $10 billion. We're getting count 10 now. Bill Huang guilty, count 10 Halligan guilty. These are counts of securities fraud. So in total, 11 charges, and I want to lay them out because the first one is racketeering conspiracy. That's basically violating the RICO statute. Both men, the CEO and CFO, were charged with that. We're still waiting for complete clarification on verdicts on that one. Then there was securities fraud, one against both one against Huang alone. And then there were 7 counts of market manipulation and a count of wire fraud against Huang as well. The market manipulation counts all related to particular stocks that Huang had huge positions in, invisible positions, given that Wall Street in many instances didn't know that he was holding the same stocks with various counterparties across Wall Street. This only became clear after the event. And this is what the Southern District is accusing Huang of. He's accused of basically running an enterprise that used schemes and various trading tactics in order to artificially push higher the stock prices in these stocks. At one point, 96% of Huang's capital was in one stock alone, and that was Viacom. He kept artificially inflating the stock's price and others, according to the prosecution, because he wanted those prices to go higher, and this hurt many on Wall Street and also retail investors. But now it looks like it's possible that Huang will be going to prison. All told, 220 years, although we know that many of these 20-year sentences will likely be served concurrently. And of course, the parties are likely to appeal. But again, these verdicts just coming in now, several guilty verdicts for Huang and at least one guilty verdict for the former CFO, Patrick Callahan. And one final point, the 2 cooperating witnesses were co-defendants in this, and they cooperated according to the defense in order to potentially lessen or dramatically reduce their jail time.
Great stuff, Vonnie. Really appreciate your walking us through all the different counts. Again, Bill Huang, the founder of Archegos Capital Management, the family office, he was found guilty of criminal charges stemming from his firm's collapse, along with his co-defendant, the former CFO, Patrick Callahan. Vonnie, thank you so much. Vonnie Quinn reporting from downtown Manhattan outside the courthouse. And Romain, I'm guessing that an appeal is likely to happen, and we'll hear, of course, from the defense when they do make their way outside afterwards.
Yeah, it'll be interesting to see what their response to this is, and the idea, not just for the appeal, but whether they actually thought that the trial was fair.
Yeah, absolutely. All right, let's go back to our conversation with Nancy Lazar. She's chief global economist over at Piper Sandler. She's still with us. And Nancy, apologies for the interruption there on that verdict. It's something that so many people on Wall Street have been anticipating and looking, we're kind of mesmerized by it, to be honest. But I want to get back to the broader markets, the broader economy as well. Throughout the 2-day testimony, Jay Powell made very clear to congressmen and congresswomen that he wanted to see more good data on inflation. But what about bad data on jobs? Is that likely to be the bigger catalyst here, more than good data on inflation for the Fed to move?
He certainly made that clear that he is worried about the job market. Keeps him up at night, I believe, he is something what he said. And we do see a clear deterioration in the unemployment rate in particular. I think that is the cleanest number to look at. Payrolls are constantly being revised, and they're being revised down, which is a business cycle signal. The unemployment rate just historically isn't revised, and it has good signal. When it increases clearly, then it does increase the odds that you are already in a recession. And we have increased. We've not yet triggered what's called, as you know, the Somme rule, but we are darn close, up 0.43 percentage points. 0.5 is when you are classically in a recession. So I think the Fed knows that. They see this deterioration. They see the increase in layoffs. They see unemployment claims. We've had a surge in bankruptcies, which is why you're getting an increase in the unemployment rate. So we think it's going to be a combination of the two, and they're connected. I would argue that you need a sustained increase in the unemployment rate to get a sustained shift down in inflation, to get that demand destruction, really squeeze out those inflationary pressures. Otherwise, we risk if the Fed eases too aggressively, too quickly, a reacceleration at some point down the road.
Hey, Nancy, we're going to have to leave it there. We got to get you back for a longer conversation. Thanks for being patient with us. Of course, a legend in this industry, of course, from her days in launching Cornerstone and ISI, now the chief global economist over at Piper Sandler. Scarlett?
All right. We were talking about the data and the CPI. What's interesting, of course, is the positioning that's taken place ahead of this report due out tomorrow and ahead of Powell's testimony. Everyone's been fairly bullish, both in the bond market and the equity market.
And it looks like they were right to be.
Yeah.
So far, so far. We haven't seen tomorrow's report, but
fair,
so far.
Fair. 1% gains for the 4 major indexes, right? The S&P, the NASDAQ, the Dow, and the Russell 2000 on top of that.
Yeah,
so kind of a broad-based advance, at least for today. And we certainly saw the Magnificent Seven names do fairly well, up 1.25%. There was some fundamental news tied to Apple, which got people excited.
Did it get people excited?
Well, it got investors excited. Maybe not
more iPhones.
Yeah.
Okay. All right.
That's better than the alternative, which was, people were thinking that there was no super cycle coming. Solid demand also for the government's $39 billion auction of 10-year notes.
AI, it's going to change everything.
You laugh. All right, this is The Close on Bloomberg. Some headlines here. Citigroup is going to be paying $61 million to the Fed. It's a fine over issues related to data quality management and risk controls. On top of that, it is going to pay about $75 million to the Office of the Comptroller of the Currency. Citigroup shares, you could see, down about 1.33% right now on this headline that it is going to be paying $61 million to the Fed and $75 million to the OCC. Jane Fraser, the CEO, making some comments saying, "We have not made progress quickly enough. We will get these areas where they need to be." So once again, Citigroup down in after-hours trading on this Fed fine. One of those big lingering issues that they still have to sort out over there. It continues on. Meanwhile, we go back to what is or potentially a big week for economic data with CPI report tomorrow morning, PPI on Friday, and of course, that's all on the heels of 2 days of testimony by Jay Powell. The move in yield somewhat subdued, but still looking at yields still holding at some of those high levels that the market had already priced in. Alex Morris joining us right now is the CEO over at FM Investments, joining us here in Studio 2 in New York. And I do want to start off with yields and the bond market, 4.6 on a 2-year. Last time I think we're 4.2, 4.3 on a 10-year yield. Yep. Do you anticipate that we're going to see any real significant movement in that?
We saw a little teeny movement today, which seems about right to price in. Unless we see 3.3 or greater, we're not going to see too much more, right? 3 isn't 2. We're looking for 2.0 before the Fed does anything. And I think Nancy was right. She's saying earlier, this is about job destruction, and we're just not going to see that much yet. So the Fed is buying some time, which is going to drive short rates more than anything else. And I think the Fed, and Jay Powell in particular, wants to steer clear of the election. So anything they can do to just keep things more or less as they are today. People are happy with 5.3% on the 90-day. T-bill and chill still works. We run TBIL, so we've seen assets come in and appreciate that. And we think that's where it stays through December. T-bill and chill, and that's been the case for a while. However, we had some bond auctions this week, and there's been solid demand. All this talk about too much supply coming on and questions over whether demand will be there at each turn. So far, it's done pretty well. Yeah, so far, so good. I mean, we've always heard that there'll be so much debt that we won't be able to absorb it, but there has proven to be an insatiable demand for U.S. debt, both abroad and at home. Every auction we hear is supposed to be weak. It's not. Even in some of the less well-traded names, like the 7-year comes out, and those auctions do pretty well. So thus far, the market has been happy to absorb it. Who's the marginal buyer that people keep forgetting or underestimating? Well, right now there's a lot of folks who are also refinancing debt. So they've owned these bonds for a while and they have to go back into something, and they're happy with 4 handles on returns. And there's a lot of more retail-esque buyers, not pure retail folks, but the sort of forgotten asset management industry, which overtook the institutional industry by total AUM this year, that is looking for that safe, easy return. I am curious about that too, just the way that retail got attracted to. Obviously, the yields is what drove them in here. Right. I do wonder if you get a flip of that, if we do see a meaningful drop in basically what you get paid out, particularly if it drops down below a 4 or something. Do people then just say, okay, I'm going to go back to something that like an equity or something that gives me a better return? Yeah, I think that will have to happen to some level. I think the fear that everyone leaves money market funds with the trillions and trillions and magically go back to the equity market probably doesn't come true, because look what's happening with the equity markets today. Yeah. If you wanted 16% return, you got that in the S&P 500 halfway through the year. Yeah. That's not so bad. What are the prospects for, I mean, there's a lot of talk about a correction in equities. When and if that happens, and of course that's a big if because people have been calling that for a while now, how do you see that impacting the bond market? Well, so you're right. A lot of folks have called for that for a long time. It seems to be the leading indicator of leaving your job as a market strategist on Wall Street nowadays. So I'm going to steer clear of that for liking what I do. But I think the bond market will be the beneficiary of some of that, right? Unlike the last few large equity changes of regime, bonds are now paying out material return. And that has actually made its way to coupons, which previously you might have got a material return in the bond market, but it was price, total return. So you had to wait 7 or 10 years to see that price action actually do something for you. Now investors can get 3, 5, 6% coupons in non-high yield debt pretty readily, and I think they like that. All right, Alex, we're going to have to leave it there. Really appreciate you stopping by. Alex Morris, the CEO over at FM Investments. A closer look here at how the market might react to some of that inflation data. Inflation data that, well, a lot of consumers are saying, look, we've been seeing this already for a long time. There's a new season of the Bloomberg show, Chief Future Officer. It begins this week, and the big focus is on, well, consumer
goods and consumer inflation, particularly with the world's largest packaged food companies. Consumers, they're getting fed up with it at the grocery store and everywhere else. It's been a challenge for CFOs, including the CFO of General Mills, Kofi Bruce. I had a chance to spend a couple of days with him out in Minneapolis at their headquarters, and he talked about how they're dealing with the pressures of historic inflation.
We have to do the things first that dampen the impact, right? That don't impact the consumer. If we do our job right and we're driving productivity, that takes some of the sting out, because that's costs that we don't have passed back, certainly ultimately to the consumer. But the other job is to make sure that if we've got consumers that are looking for value, that we're hitting them with the right promotions and the right incentives, as well as we've got pack sizes to kind of meet their price point expectations. That's a big part of the job.
And that was just a small snippet of my interview with the CFO of General Mills. It's part of Bloomberg's Chief Future Offer series. The first episode of the latest series kicks off tonight at 9:30 p.m. New York time. And this was a great conversation, Scarlett, because in addition to their focus on inflation, I mean, obviously they're a gigantic consumer products company, so they have to really be in tune with economic conditions and what their consumers are feeling. But he also talked about trends in terms of what we're eating, the idea of the Ozempic effect, and the idea that people are looking for healthier options, higher protein options, and they've got a whole plan for that as well.
Yeah, I mean, that has got to be something that they had to implement into place really quickly, because it kind of took everyone by storm. But one thing that's been surprising is this push for more protein, because people whose appetites are kind of tamped down, they still want to be eating healthily. And so in a way, it's increased the demand for protein, healthy food, and decreased demand for the unhealthy food.
And you know, and they're doing a lot. It was interesting to their strategy, because they do some stuff internally in terms of developing this stuff, but they've actually been doing a lot of acquisitions. And when we were down at their test kitchen, which is like this expansive place where they just test all the, I mean, it was really like a dream come true. So they had the owners of this brand called Carpe Diem that they effectively bought, General Mills bought. And it's basically a low carb, low calorie pasta, but it has like higher fiber, higher protein, look, when you take, if I didn't tell you this was like a healthier pasta, you would never know. It was fantastic. And it was just a basic, you know, they had basic sauce. It wasn't anything like crazy they put on it. And so it was great. And I got to taste, of course, I also got to taste like the cookies and stuff like that too. But
what was the favorite thing you tasted?
Well, they were doing this new type of cookie. I forgot what the flavor was, but it was, you know, it was just kind of like chocolate chip. But it wasn't like a healthy cookie. It was like a real cookie. But they work with flavors a lot. This idea of sort of what consumers want, and they have a lot of this real time data that they collect from consumers who basically will say, we like this, we don't like that, and then they try to make changes on the fly.
You see a lot of stuff in matcha flavor now. Like, that's a big thing.
Yeah, I can't get into that.
Really?
Yeah, matcha is kind of overdone.
No. Matcha and chocolate, good combination.
All right, when we come back, we're going to set you up for what to watch tomorrow. This is Bloomberg. All right, here's what markets are going to have their eye on over the next 24 hours. And Scarlett, it's here. Earnings season. It begins tomorrow.
Yeah, well, we've got a good cross-section of the economy. We have Delta, of course, for the transportation sector, PepsiCo, and ConAgra brands.
Yeah, absolutely here. And I mean, I always love this type of these types of reads on the economy. I guess travel and whether we're still buying food.
Yeah,
which
buying food, paying for soda, and of course, that is all part of the drum roll to the big one.
Yeah, which is, of course, the big CPI data at 8:30 a.m. tomorrow.
Yeah, the headline number is an increase of 3.1% year over year, according to economists that we surveyed. Core, when you strip out energy prices, an increase of 3.4%.
Yeah, the Fed loves to strip out things there. We're also going to get jobless claims also at 8:30 a.m. tomorrow. And a lot of Fed speak as well. More Fed speak. Do we need more?
Well, I mean, it's scheduled after, you know, the two big data points, which touches on the Fed's dual mandate, right? You have employment, you also have inflation. So they'll have a lot to respond to.
Okay, well, we're going to hear from Bostic, my second favorite Bostic out there, as well as Muselman and a couple other folks as well. And then we're actually going to get a wrap-up of that NATO summit here that's been taking place right here in the U.S.
Yeah, and also worth mentioning that some of President Biden's closest aides are scheduled to meet with Senate Democrats tomorrow also.
All right, well, we'll keep an eye on that. Stick around. Balance of Power will have a full breakdown here of all that's going on with Biden there, and we'll be back tomorrow here for all your markets coverage right here on The Close on Bloomberg.